The four-stage liquidity pattern has started. A pleasant 17% move in silver overnight is not a bounce. It's the market flashing a structural warning about the dollar system itself, about liquidity, collateral, and the price of money. At the exact moment, most people are staring at the wrong screen. When silver does that, it isn't telling you a story about jewelry demand or a meme trade. It's telling you the plumbing is shifting. The terrifying part is this. The sequence is not mysterious, not random, and not new. It is a predictable mechanism that repeats when a reserve currency regime collides with math, debt rollover math, yield math, and liquidity math. Recent estimates still put the dollar on one side of the majority of global FX transactions, roughly near 9 out of 10 trades, and a very large share of global trade and debt remains effectively dollarized through invoicing, funding, and collateral. That's not a patriotic statement. That's a dependency diagram. If you understand that diagram, you understand why a silver shock move is often a symptom, not a cause, and you understand why this moment is not a debate about bottom or trap in a single metal. It's a question of which phase of a mathematical pattern we're entering. Here is the mechanism, and you can test it across history without faith, only with balance sheets and incentives. It begins with a setup, the foundation stage where a currency system earns trust through convertibility, restraint, or credible rules. Then comes expansion, where credit grows faster than real output, and the rules get adjusted in the name of flexibility, growth, or stability. In that stage, debasement doesn't always mean hyperinflation at first. It can mean financial repression, negative real yields, or an ever larger promise stack built on the same base collateral. After that comes crisis, the loss of control stage where the system tries to defend itself with volatility. You see stress in FX first, then in funding markets, then in rates, then in real economy prices, often all at once, but never evenly. And then comes the inevitable outcome, not necessarily collapse overnight, but a reset of terms, a broken peg, a repricing of the reserve asset, a forced tightening, a policy pivot, or an institutional change that makes yesterday's assumptions invalid. The details vary. The physics does not. When promises grow faster than the ability to honor them in real terms, the system must choose. Default openly, default quietly through debasement, or restructure the game board. Silver and gold are not investments in that story. They are pressure gauges and escape valves. When they gap, something is squeezing. To feel how inevitable this is, stop thinking like a trader and start thinking like a dealer in collateral. The global system is built on good assets that can be pledged, financed, rehypothecated, and used to settle. For decades, U.S. Treasuries have been the premier collateral, deep, liquid, and assumed safe. But collateral is not just about credit quality. It's about price stability, funding terms, and confidence that the real value of repayment won't be diluted. The moment inflation becomes sticky or volatility spikes, the collateral's reliability changes. Haircuts rise, funding costs rise, dealers step back. That is when a metal that has both industrial utility and monetary reflex, silver, can jump violently because it sits at the intersection of physical constraint and paper leverage. In the paper market, the supply is infinite until it isn't. In the physical market, supply is rigid in the short run. That gap between paper elasticity and physical rigidity is where shock moves are born. The first historical case study is the cleanest demonstration of the mechanism in modern time. The breakdown of Bretton Woods culminating in the Nixon shock of 1971 and the inflationary turbulence that followed. The setup stage was the post-World War II order. The United States anchored the system with the dollar convertible into gold at $35 per ounce for foreign official holders, while other currencies were pegged to the dollar. That architecture created stability and accelerated trade. It worked because the U.S. held a huge share of global gold reserves and because the world accepted the rule. Dollars were as good as gold, at least for central banks. The rules were legible, the foundation was visible. Then the expansion stage arrived, and it arrived through policy choices that sounded reasonable in the moment. The U.S. financed large fiscal commitments, Vietnam War spending, Great Society programs, while maintaining a strong dollar promise. Dollars flowed abroad through trade deficits and overseas military expenditures. Foreign central banks accumulated claims on U.S. gold via dollar reserves. The promise stack grew. And here's the key. In an expansion stage, the system doesn't break because policymakers are evil. It breaks because constraints are politically inconvenient. Maintaining convertibility required either slowing domestic credit growth, tolerating higher unemployment, or raising taxes, choices that are always unpopular. So the system drifted. It kept issuing claims faster than the base asset could support. Crisis, the loss of control stage, became visible as foreign holders began to test the promise. France and others asked, in effect, "Can I exchange these dollars for gold as promised?" Gold outflows pressured U.S. reserves. The market began to sense that the convertibility guarantee was a one-way door, easy to promise, hard to honor. This is what reserve currency crisis looks like. It's not a dramatic bank run on a street corner. It's an institutional run through official channels and capital markets. You see it in FX pressure, in reserve drains, in credibility fractures. The inevitable outcome arrived on August 15, 1971, when President Nixon suspended the dollar's convertibility into gold, closing the gold window. The stated reasons were practical: defending the dollar, protecting U.S. interests. The effect was mechanical. The system moved from a rule-based convertibility anchor to a discretionary fiat regime, and once that anchor snapped, the price level and inflation expectations had to reprice. The dollar could no longer claim a fixed weight in gold. It became a policy instrument. What happened next demonstrates why precious metals matter in this mechanism. Gold was revalued upward over time. Silver experienced explosive volatility. The 1970s were a laboratory of inflation transmission. As the dollar's external constraint loosened, domestic monetary conditions and fiscal choices translated more directly into price dynamics. Inflation surged, not as a single event, but as a series of waves: energy shocks, wage pressures, and a feedback loop of expectations. Bond yields rose because lenders demanded compensation for inflation risk. Funding markets became more sensitive to credibility, and the public learned painfully what negative real rates do. They punish savers, they encourage speculation, and they push capital toward hard assets and inflation hedges. In that era, silver and gold didn't go up because everyone suddenly loved shiny metal. They rose because the denominator, the currency unit, was being repriced. They rose because the system's promise stack was being discounted. And volatility rose because policymakers were fighting two fires: an economy that still needed growth and a currency regime that needed credibility. That is how the crisis stage expresses itself. Tightening and easing become whiplash, and markets stop believing in smooth landings. The mechanism proved itself in full view. Now the second case study, often misunderstood, is the U.S. tightening cycle that culminated in the Volcker era, because it looks like a policy triumph, but it is also a forced resolution of the same mechanism. After the 1970s inflationary deterioration, the setup had already been compromised. The system was operating in late expansion and active crisis. The dollar's credibility was weak, inflation expectations were unanchored, bondholders demanded higher yields. When the price of money becomes unstable, everything else becomes unstable too: wages, rents, commodities, and risk assets. You can't manage that with messaging. You can only change incentives. The crisis stage intensified as inflation stayed high into the late 1970s. The dollar was under pressure. The U.S. faced a credibility gap. If it continued to accommodate inflation, it risked an even deeper loss of confidence in dollar assets. If it tightened, it risked recession and financial distress. That is the trap inside the mechanism. The longer expansion is allowed to run, the more brutal crisis resolution becomes. The inevitable outcome arrived in the form of aggressive tightening under Federal Reserve Chairman Paul Volcker beginning in 1979. The central bank targeted money supply growth more forcefully, allowing interest rates to rise dramatically. This was not a gentle policy adjustment. It was a reassertion of the currency's discipline through rates, using unemployment and recession as the political price of restoring credibility. Bond yields surged, borrowing costs rose, credit conditions tightened sharply. It was, in a sense, a controlled burn, an attempt to stop the inflation fire by starving it of fuel. Watch what precious metals did around this pivot, and you can see the system's pressure changing in real time. Gold and silver had surged as inflation and currency doubts intensified. But when real rates rose and the market believed the tightening was credible, metals faced headwinds. That's not because metals stopped being valuable. It's because the opportunity cost and the dollar's credibility were being repriced. In other words, the metal complex was responding to the same plumbing: real yields, liquidity conditions, and confidence in the settlement unit. This case study proves something crucial for the present. The system can resolve the mechanism in different directions, but it cannot avoid resolution. If policymakers choose discipline late, the resolution is violent through rates and recession. If they choose accommodation late, the resolution is violent through debasement and purchasing power loss. Either way, volatility is not a temporary glitch. It is the system's method of transition. Now bring these lessons forward into what a pull 117% overnight silver move is actually whispering about the modern machine. Today's dollar system is not Bretton Woods. It's bigger, more complex, and more leveraged. It runs on collateral chains, dealer balance sheets, and derivatives that turn time into tradable risk. That means liquidity is not a synonym for money printing. Liquidity is the ability to fund positions, roll debt, and make markets without punitive haircuts. When liquidity tightens, it doesn't tighten politely. It tightens where leverage is highest and where collateral quality is questioned. Bond yields are not just numbers. They are the price of rolling the world's largest debt stack. Every auction is a stress test, not only of demand, but of confidence. When yields rise sharply, the government's interest burden rises, private borrowing costs rise, and global financing conditions tighten. because so much of the world is priced off US rates. When yields fall sharply for the wrong reasons, growth fear, deflation pressure, crisis demand for safety, you also get stress because it can signal a rush into liquidity and a scramble for collateral. Either direction can break something. The mechanism does not require yields to only go up. It requires volatility, and volatility is what destroys fragile structures. FX is where the cracks show early. A dollar shortage tightens global conditions because offshore borrowers need dollars to service dollar-denominated debts and to settle trade. A dollar glut can export inflation and destabilize pegs and managed exchange rates. Either scenario transmits stress through import prices, energy pricing, and capital flows. Inflation and deflation aren't just domestic CPI stories. They are cross-border forces channeled through FX moves and funding spreads. When the dollar strengthens rapidly, it can crush emerging market balance sheets and commodity demand. When it weakens rapidly, it can ignite commodity inflation and push savers into real assets. The system oscillates, and those oscillations are not random. They are the machine searching for equilibrium it can no longer sustain. This is where precious metals become boringly terrifying. Gold is the monetary metal, the confidence metal. Silver is the hybrid, the monetary reflex plus industrial constraint. Silver's supply-demand mechanics are fundamentally less elastic than a paper screen implies. Mine supply cannot surge overnight. Scrap supply responds with a lag. Industrial demand can be sticky due to manufacturing cycles and substitution limits. Meanwhile, the paper market can create exposure at a scale that dwarfs deliverable inventory through futures, options, unallocated accounts, and swaps. That structure works when most participants treat it as a cash-settled game and when confidence in delivery is high. But in stress moments, the question becomes, can you deliver the metal, not just the price? That's when premiums matter. That's when inventory drawdowns matter. That's when the spread between paper quotes and physical availability becomes the story. A plunging 17% overnight move can be triggered by many immediate catalysts. Short covering, a sudden shift in rates, a headline, a positioning squeeze. But the magnitude is the tell. Big, discontinuous moves tend to happen when liquidity conditions change faster than market makers can reprice risk. Dealers widen spreads, options gamma forces hedging, stop losses cascade. And if the physical market is simultaneously tight, if deliverable inventories are drawing down, if premiums are rising, if refineries and mints are backlogged, paper sellers become less confident. Because the escape route from paper, claims into metal, becomes more expensive. That's why silver can move like a currency in panic. It is one of the few assets that straddles monetary hedging and real economy utility. There's also a psychological trap here, and it repeats in every cycle. People see a violent rally and ask, is this the bottom? Others see the same rally and say, it's a bull trap. Both camps are thinking in a single asset frame. The correct frame is systemic. In the mechanism, shock moves often happen at transitions, when expansion begins to fray into crisis, or when crisis begins to resolve into a new policy regime. In those transitions, bounces aren't just bounces, they are repricing events. They are the market forcing the system to acknowledge a new constraint. And the constraint, always, is the same. You cannot roll an ever-growing pile of promises forever at stable prices without either devaluing the promise, raising the price of money, or breaking the structure. The dollar system can stretch further than most people believe, because it is embedded in trade, debt, and reserves. But that embeddedness is precisely why stress transmission is so powerful when it arrives. When the center sneezes, the periphery doesn't just catch a cold, it catches funding stress, FX stress, inflation stress, and political stress all at once. So when silver jumps some 117% overnight, treat it like an alarm bell, not a lottery ticket. It is the kind of move you see when volatility is seeping from the margins into the core, when the bond market is no longer a sleepy allocator but a live wire, when auctions begin to matter again, when funding costs move in uncomfortable ways, when FX starts to punish weak balance sheets, and when the paper versus physical distinction in metals stops being academic. Silver doesn't need to know the next policy decision. It only needs to reflect the market's tightening tolerance for leveraged claims. The historical record gives you the blueprint. In the early 1970s, the rules broke and metals repriced the denominator. In the Volcker era, discipline was reimposed, and the price of money crushed inflation at a steep cost, reshaping the landscape for everything from bonds to commodities. Different outcomes, same mechanism, foundation, expansion, crisis, reset. The question now is not whether the pattern exists, it's where we are inside it, and which channel is carrying the stress. Yields, FX, funding markets, or the real economy. That is why the next step is unavoidable. Once you understand the mechanism, you stop reacting to headlines, and you start reading the machine. The dollar's strength and weakness as a transmission line, bond yields and auctions as stress tests, funding markets as the bloodstream, volatility as the symptom, and silver and gold as the gauges that spike when the system's pressure changes too fast. The only thing left is to map the mechanism onto the present point by point until the bottom or trap question becomes what it really is, a diagnostic of where the dollar liquidity cycle is turning next. Track yields, FX stress, and physical silver tightness before the next volatility wave. So now we do the only thing that matters. We stop treating that plus 17% as a trade, and we read it as a systems diagnostic. The bottom versus trap question is not answered by a candlestick. It's answered by whether the dollar liquidity machine is moving from foundation into overextension, from overextension into stress, and from stress into a forced outcome. Before we map it onto today, you need one more proof point, one more historical mirror where the same mechanism expressed itself through FX, dollar funding, yields, and then a violent repricing of real assets as the system tried to regain control. In the mid-1990s, Southeast Asia looked like the future. Thailand, Indonesia, South Korea, Malaysia, high growth, foreign investment, booming property markets, and currencies managed tightly against the US dollar. That was the setup. A stable FX regime created the illusion of low currency risk. It lowered borrowing costs. It attracted capital. It encouraged banks and corporates to borrow in dollars because the exchange rate looked safe, and dollar funding was cheaper than local funding. The foundation wasn't a gold peg. It was confidence in a policy-managed peg, and the belief that reserves and credibility were enough to hold it. Then the expansion phase took over, and it was textbook. Credit growth exploded faster than productive output. Local banks and corporates built balance sheets stuffed with short-term dollar liabilities, funding long-term domestic assets, real estate projects, speculative expansion, and investments that only worked under stable FX and easy rollovers. Current account deficits widened. The promise stack grew, and it grew in the most fragile way. Short-term foreign funding layered on top of domestic asset bubbles. The system looked stable precisely because it was being fed constantly by external capital, like a patient kept awake by an IV drip. This is how overextension disguises itself. Calm FX, cheap funding, and rising asset prices. Crisis began when the market questioned the peg and the quality of the collateral behind it. Thailand's defenses weakened as reserves were used to support the baht and as speculative pressure rose. By July 1997, Thailand was forced to float the baht. That single event was not a local currency story. It was the instant repricing of dollar liabilities across the region. When local currencies fell, dollar debts effectively grew in local terms overnight. Balance sheets cracked. Banks faced runs. Funding evaporated. The offshore dollar market tightened because lenders realized they were not being paid for FX risk they had been ignoring. This is the loss of control stage. The currency peg breaks, and suddenly the entire credit system has to reprice at once. The outcome was inevitable because the mismatch was mathematical. Once the peg credibility broke, the region could not keep rolling short-term dollar debt on the same terms. The system had to choose between burning reserves to defend the currency, hiking rates to attract capital and kill domestic demand, or accepting devaluation and dealing with the balance sheet wreckage. Most ended up with some combination plus IMF programs and brutal adjustments. Interest rates spiked. Recession followed. Asset prices collapsed. The stable growth miracle turned into a forced deleveraging. And the deeper lesson is the one people refuse to learn. Global dollar funding can feel like oxygen until it becomes a choke chain. When you build prosperity on cheap external dollars and stable FX, the crisis arrives not as a gentle slowdown, but as a sudden inability to roll the liabilities that financed the boom. That case study proves the mechanism in the language of modern finance. Stable FX and cheap dollars establish the setup, credit expansion, and currency mismatch produce overextension. A break in confidence triggers funding stress and FX disorder, and the system resolves through devaluation, rate shock, restructuring, or external support. Not ideology, mechanics. Now apply that same mechanism to today's dollar system, and you'll see why silver's violence matters, and how to tell bottom from trap. Start with the setup that still defines the world. The dollar is not just America's currency, it's the settlement layer for global trade, the dominant invoicing unit for commodities, and the core collateral reference for global finance. Treasuries are treated as the cleanest collateral, and U.S. money market plumbing, repo, swaps, treasury bills, sets the marginal price of global funding. That setup is reinforced by habit, network effects, and the sheer depth of U.S. markets. It's why global stress reflexively runs through the dollar first. Check. Now move into expansion and be brutally honest about what expansion means in the 2020s. It means a mountain of debt that must be rolled, not paid down. It means deficits that require constant auctions. It means a system that tries to stabilize growth by manipulating the price of money, sometimes suppressing real yields, sometimes whipsawing them. Expansion also means leverage, hiding in places people call relative value instead of leverage, basis trades, duration hedges, swap books, volatility selling, and carry strategies that work until funding costs move. In this phase, the promises don't just expand, they interlock. Verified. Then watch where crisis shows up first, in the price and availability of dollars outside the United States, and in the credibility of the Treasury market's absorption capacity. When the market starts caring about who is buying the auctions and at what price, you're closer to the loss of control stage than you think. Auctions are not ceremonial, they are the funding heartbeat. The bid-to-cover ratio tells you if demand is healthy or forced. The term premium tells you if investors are demanding extra compensation for duration risk and fiscal uncertainty. Real yields tell you what the market believes about growth and inflation adjusted for credibility. And when these variables start moving fast together, you're watching stress propagate through the foundation. Undeniable. Here is the step-by-step translation into today's plumbing, because the trap versus bottom answer is hidden in these linkages. First, the USD strengthens or destabilizes not only from US growth, but from dollar scarcity and collateral hunger. That shows up in cross-currency basis, in short-term funding costs, in the demand for bills, and in sudden stress in emerging market FX. If the dollar is firm because global funding is tight, that's not bullish stability. That's a squeeze. And squeezes break weak balance sheets. Check. Second, inflation and deflation are not moral outcomes. They are transmission effects. A strong dollar can export deflationary pressure to the rest of the world by tightening global financial conditions and lowering local demand. A weak dollar can export inflation through commodity pricing and import costs. But the most dangerous scenario is the one that confuses people. Inflation in essentials with deflation in discretionary demand. A world where policy tries to fight inflation while growth is slowing. That's when volatility spikes, because markets can't price the path of rates. Verified. Third, debt rollovers become the central drama. Governments roll at auction. Corporations roll in the bond market. Banks roll in wholesale funding. When yields rise, the rollover cost rises. When yields fall due to fear, credit spreads can still widen, making rollover harder. The stress is not high yields or low yields. The stress is on stable yields combined with heavy refinancing needs. That's why you must watch not just the level of yields, but the rate of change, the auction tails, and the dealer balance sheet capacity to intermediate. Undeniable. Fourth, the funding markets translate that stress into immediate pain. Repo is where collateral meets cash. When repo rates spike or when haircuts rise, leverage structures start to wobble. Swap spreads and funding curves can reveal when banks and dealers are stepping back. If the basis trade is crowded, long cash treasuries financed in repo, hedged with futures, the system becomes fragile to small changes in repo rates and treasury volatility. When volatility rises, margins rise. When margins rise, positions get cut. That selling can push yields higher, which triggers more margin pressure. That feedback loop is how the safest market becomes a volatility engine. Check. Fifth, risk assets respond as liquidity, not optimism, drives price. Equities, credit, and high beta trades can levitate when liquidity is abundant and real yields are falling for good reasons. But when real yields rise because the market is demanding compensation, or when funding costs rise, you get the ugly version of volatility. Correlations go to 1, hedges fail, and the market sells what it can, not what it wants to. That's when you see sharp intraday reversals and disorderly price action across assets. Verified. Now we arrive at the metals complex, and this is where the silver shock move stops being a curiosity and becomes a diagnostic. Gold tends to lead when the market is losing confidence in policy credibility and when real yields are falling or becoming unstable. Silver can lag and then explode because it sits on a tightrope between monetary hedging and industrial reality. In calm times, paper silver behaves like a levered macro instrument, traded through futures, options, and unallocated exposures that can be expanded with keystrokes. But in stress, the physical constraint becomes relevant. The question becomes delivery, not just exposure. And delivery is where the paper versus physical gap can widen. Look at the mechanics. Futures markets price paper, claims that are often closed out financially. Physical markets are governed by inventory, fabrication capacity, and the willingness of holders to part with metal. If inventories draw down, if deliverable stocks and recognized warehouses trend lower, if mints and wholesalers quote rising premiums over spot, if retail and industrial buyers compete for available bars, then the paper price can be forced higher because sellers realize the off-ramp into physical is getting expensive. At the same time, a volatility spike can force shorts to cover, and the covering can collide with thin liquidity. That combination produces the kind of overnight gap that people mislabel as a bounce. Undeniable. So what is the trap versus bottom test in this framework? A trap is when the metal spikes primarily from positioning and short covering, while the underlying dollar and funding stress is easing. When real yields are stabilizing, Term premium is not rising, auctions are clean, repo is calm, swap spreads are not screaming, and FX stress is receding. In that environment, silver can give back the move because the pressure gauge spiked, but the pressure was released. A bottom, meaning a durable repricing regime shift, happens when the spike aligns with persistent systemic stress, unstable auctions, rising term premium, real yields that are moving unpredictably, dollar funding that stays tight, and FX fractures that don't heal quickly. In that environment, silver's move is not overdone. It's the early repricing of the denominator and the funding regime. Check. This is why you must track the boring indicators, not the loud narratives. Watch the Treasury auction results, bid to cover, tails, and indirect bidder participation. If auctions begin to require higher concessions to clear, the system is paying more to roll its promises. Watch the term premium and the shape of the yield curve. If long-end yields rise because investors demand compensation rather than because growth is roaring, that's a credibility cost. Watch real yields. If they rise sharply, they can pressure metals in the short run, but if they become unstable, that instability itself can support gold and, after a delay, ignite silver. Watch swap spreads and funding metrics for signs that dealers are rationing balance sheet. Watch repo conditions and any signs of collateral scarcity or rising haircuts. Watch the dollar's behavior against a basket of stressed currencies, not just a single pair. The dollar can be strong and dangerous, or weak and dangerous depending on why. Verified. Then watch the physical signals, because silver's special risk and opportunity live there. Premiums over spot, delivery times, and consistent inventory drawdowns are not retail noise when they appear alongside macro funding stress. They are evidence that the paper market's elasticity is meeting the physical market's rigidity. Industrial demand doesn't vanish overnight. Fabrication capacity doesn't expand overnight. Mine supply doesn't surge overnight. So when investment demand reappears under stress, the physical market can tighten quickly, forcing the paper price to chase it. That is how silver becomes a stress valve, not a speculation toy. Undeniable. Now connect this back to the dollar system's inevitable outcome stage. If the system tries to resolve stress by cutting rates aggressively while deficits remain heavy and inflation risks are not fully extinguished, you risk debasement dynamics, weaker real returns on cash and bonds, stronger incentive to escape into scarce assets, and potentially renewed commodity inflation. If the system tries to resolve stress by keeping rates higher for longer to defend credibility, you risk funding accidents. Something breaks in credit, in housing, in regional banks, or in leveraged strategies that depended on cheap rollover. Either path is volatility rich. Either path feeds demand for hedges. And in both paths, gold tends to hold the narrative of confidence, while silver amplifies the cycle with its own supply-demand constraints and paper leverage. Check. That is why the right posture is not all-in bullish or everything is a trap. The right posture is conditional. Read the machine, then act. If you see auctions weakening, term premium rising, real yields unstable, dollar funding tight, and FX stress spreading, you treat the silver shock as a regime signal, not a one-day anomaly. If you see those pressures easing cleanly, funding calm, auction strong, FX stable, you treat the shock as a volatility event that can mean revert. Verified. Now the warning, because this is where people lie to themselves. This time is not different. The words change, AI, innovation, productivity miracles, but the mechanics don't. American exceptionalism is not a law of physics. Tech will save us is not a funding strategy. Modern optimism is not collateral. When the dollar system enters a phase where promises and rollover needs collide with volatility and political constraints, the machine does what it always does. It transfers the cost through FX, yields, and liquidity. The only question is who recognizes it early and who becomes the liquidity exit. So here's how you keep yourself out of the trap. Think in terms of regime shifts, not predictions. Watch the auction calendar like it's earning season for the dollar. Track real yields and term premium for credibility strain. Monitor dollar funding stress signals and repo conditions for plumbing friction. Observe FX stress in vulnerable currencies as the early tremor. And in metals, stop arguing about spot quotes alone. Watch physical premiums, delivery tightness, and inventory trends as confirmation that the paper market is being forced to respect the physical constraint. Don't chase candles. Position around conditions. Don't confuse volatility with opportunity unless you know what's driving the volatility. And never forget the simplest rule of crisis markets. When funding tightens, the market sells what it can, not what it should. So your job is to avoid being the forced seller. If you want to stay ahead of this, treat the next video as mandatory. We're going to walk through how the machine was built, how the plumbing, the collateral hierarchy, and the policy reflexes create the next stage, and how to recognize the moment the system flips from managed volatility to self-reinforcing stress. You don't need hype, you need a dashboard and a calm hand. The verdict is simple, and it's uncomfortable. The plus 15% silver move was not a random gift, and it was not a harmless glitch. It was the system briefly revealing its pressure. The only rational response is to measure that pressure in yields, auctions, funding, FX, and physical tightness, and then decide whether you are watching a trap snap shut or a new floor being poured under the market. Are you reading the machine, or are you waiting to become its exit?